So OSFI plays an essential role in building and preserving the resiliency in Canada's financial system. And OSFI, as a member of the Basel Committee of Banking Supervision, has participated in the development of the Basel Framework. So last month, OSFI launched an industry consultation on the proposed regulatory changes to introduce the latest and final round of the Basel III reforms. Along with that, in particular, there was a consultation from OSFI in results to changes to enhance the proportionality of its capital and liquidity regime so they remain appropriate for smaller and less complex banks. So with that, I'm delighted to introduce Ben Gully, Assistant Superintendent of Regulatory Sector of OSFI, who will discuss these proposals in the context of our Australian market and what they mean for our financial institutions. Ben has been the Assistant Superintendent from OSFI since 2017. His responsibilities in the regulatory sector includes overseeing OSFI's policy-related functions, including capital, accounting, legislation, and approvals. As Assistant Superintendent for the risk support sector, he oversaw the assessment of credit, market, and liquidity risks, non-financial risks, including people and technology risks, and risk surveillance and risk analytics. Previously, Ben was Chief Risk Officer for the Australian Prudential Regulatory Authority of APRA, where he was responsible for enterprise strategy and risk, performance, and quality assurance. He's also worked at the Bank of England within the area of financial stability. And certainly as an Aussie who spent many years dealing with APRA in the global banking sector, I'm interested in hearing about Ben's experience of managing risk and building financial stability with his global perspective. Welcome, Ben, and over to you.
Thanks very much, Bruce, and really appreciate the opportunity to be with you today. And just before I start, I'd like to give a shout out to the 30 members of your Emerging Leaders program signed in today. Just in recognition, it's great to have you join us today. So good afternoon. Obviously like to thank the Global Risk Institute for hosting my remarks today. The word global is in your name, given the scope of your horizons, and having Bruce and his colleagues based in Canada is testament to the long-standing strengths of Canada's financial system. The domestic and global dimensions of your work mirror in some ways the subject of my speech. That is, I'll talk about how the internationally agreed upon Basel III reforms are providing a foundation for a resilient banking system and how our domestic implementation of these reforms will improve the existing regulatory framework and overall safety and soundness of Canadian banks. And in case there is any doubt, this final phase of Basel III is indeed coming to an end, even if it may not have felt like it over recent years. A few months ago, Superintendent Jeremy Rudin spoke about the ongoing strength of Canada's banks in the face of a pandemic. As he said at the time, the Canadian banking system continues to demonstrate the resilience for which it is known around the world. Of course, there is no reason for complacency, whether in the industry or at OSFI. Even as more Canadians get vaccinated every day, there is still a lot of uncertainty about the road ahead. We must also consider the risks that already required our attention before the pandemic, such as those stemming from household and institutional indebtedness. Therefore, we all have to stay ever vigilant, especially in what appears to be a slow and tentative journey towards a post-pandemic Canada. Banks in this country have risen to the multiple and fluid challenges brought on by the pandemic, and Canada is stronger for it. Having a firm foundation within our banking sector continues to provide benefits to the financial system as the economy from coast to coast to coast acts and reacts to a range of unprecedented pressures. As well, by the time the pandemic began to take hold, just over a year ago, OSFI's pursuit of post-global financial crisis enhancements to Canada's regulatory regime meant we were already well prepared. We were ready to take on the then unknown challenges ahead of us from a position of relative strength, the sheer scale and overlapping nature of those challenges notwithstanding. This approach reflects our view that adherence to well-designed international standards is in Canada's national interest, as well as that of federally regulated financial institutions. This is because the domestic implementation of global standards contributes to the strong reputation of our financial system, and it helps Canada's banks to attract capital and funding, both domestically as well as from investors around the world. Capital markets are both confidence sensitive and global in nature, so it's vital that OSFI's rule set maintains credibility on an international stage. This is accomplished by implementing rules that are consistent with internationally agreed upon frameworks and which are applied to internationally active banks from other jurisdictions. Moreover, Canada's commitment to these standards puts the country in a position where it is able to influence international dialogue, something that is important given the broader economic benefits for trade, investment, and international cooperation. And this brings me back to the main topic today, how OSFI's finalization of the Basel III framework is creating conditions for an even stronger and resilient banking system. The ongoing resilience of the banking sector underscores the need to stay focused on the appropriate design of prudential regulation. The Basel III reforms highlight the importance of capital and liquidity to a bank's viability. Of course, capital being the measure of the capacity that a bank has to absorb losses, while liquidity is a measure of a bank's ability to make good on its obligations, such as deposits as they come due. The Basel III reforms are a consolidation of recently agreed and previously announced enhancements to international standards that have occurred during the post-GFC period from 2009 onwards. Developed by the Basel Committee on Banking Supervision, or BCBS, the Basel framework is a consolidated set of standards for bank capital, leverage, and liquidity that has evolved over time in response to changing market conditions. Basel III was built on the foundations and limitations of two preceding frameworks. The Basel Capital Accord, or Basel I, gave financial regulators a global standard to think about in assessing capital adequacy. And Basel II improved the way regulatory capital requirements reflected underlying risks and reinforced the role of supervision and market discipline in achieving sound prudential outcomes. With over 10 long years of developments and improvements in Basel standards post-GFC, we are now finally able to draw a line in the sand and complete these changes as part of the consolidated package of Basel III reforms. And while COVID-19 has provided for a brief pause in global implementation to allow the financial system to focus on the pandemic, our attention now returns to the final rollout of these reforms ahead of the domestic start date in Canada of fiscal year 23. We think this is critical to preserving resilience in the financial system by acting on the lessons of the GFC while allowing standard setters to move forward and focus on future threats and vulnerabilities. OSFI's implementation of the Basel III reforms reflects three key principles. One, implementing it in a way that's fit for Canada. Two, setting the right incentives through improved consistency and risk sensitivity. And three, enhancing proportionality in our framework. Let us turn to the first principle, fit for Canada. OSFI has a long tradition of being an active member of the BCBS. We are committed to the development and implementation of global standards for internationally active banks, and our engagement is critical to ensuring good outcomes for Canada as part of a well-functioning global financial system. At the same time, the finalization of global standards is only the first step towards domestic implementation of rules for capital and liquidity adequacy. These standards serve only as a minimum upon which to develop domestic rules. There remain areas of interpretation and optionality that require clarity for domestic purposes, which in turn require robust public consultation to ensure our approach remains well tested and understood. As well, while public regulation is a good starting point to determine capital and liquidity adequacy, there also remain important differences in business models and risk management practices at individual banks that can't be easily captured by a single rule. And so, we consider supervision, the review and risk assessment of financial institution safety and soundness, as a critical part of the overall capital and liquidity adequacy regime. As part of this effective supervisory regime, we also believe that strong financial reporting is critical. Transparency demonstrates adherence to our prudential requirements and, supported by high-quality audits, reinforces the strength and resiliency of the Canadian system. We also recognize that the complexity of the regulatory reporting continues to increase, due in part to impacts like the Basel III reforms. We are working to address this through a recently released OSFI consultation paper entitled Assurance on Capital, Leverage, and Liquidity Returns. Through that paper, we propose enhancements to align assurance expectations and seek feedback to help us create future guidance for external auditors and banks. Now on to our second principle for implementation. Key changes to the domestic capital framework aim to improve the risk sensitivity of the capital rules and provide the right incentive structures to banks. The final Basel III reforms improve the risk sensitivity of our framework by removing or limiting the use of models in areas where the range of outcomes produced by the models led to unwarranted variability across institutions and potentially inappropriate changes in capital requirements. For example, underlying internal ratings-based approach to credit risk, we have removed the ability for banks to estimate certain parameters for low default portfolios, such as exposures to financial institutions and large corporates. We have also introduced minimum floor levels on certain input parameters used in the calculation of credit risk capital requirements for retail exposures. Additionally, Basel III is better aligning the capital with the risk under the standardized approach to credit risk by having more risk-sensitive rules, such as more varied risk weights for different asset classes like residential and commercial real estate, rather than a flat risk charge. We believe this approach allows banks to make lending decisions that are more in line with their risk appetite. To confirm this, and as part of the current consultation phase, we are conducting a quantitative impact study to assess the impact of the proposed changes on our domestic institutions. Of course, Basel III was developed with large internationally active banks in mind, but many of the key tenets within the framework aimed at enhancing resiliency, like improving risk sensitivity and incentives, can be applied to banks of any size through enhanced proportionality, our third principle. Other jurisdictions, such as the US, have had a tradition of more clearly distinguishing expectations for banks based on their size and complexity. Our work in preparing for the implementation of Basel III provided us with a natural opportunity to review our overall banking framework and revisit the capital and liquidity regime for smaller, non-internationally active banks as well. Using the Basel III reforms as a starting point, we developed unique made-in-Canada proposals tailored more appropriately to the risks of our smaller institutions. Proposals aim to strike a balance between improving the risk sensitivity of the requirements for small banks and helping them to address rising complexity of the frameworks to make them more effective and thereby fit for purpose. Just over a month ago, we outlined these proposals in a new draft SMSB capital and liquidity guideline. The new draft guideline serves as a reference tool for stakeholders to help them understand which parts of our capital, leverage, and liquidity guidelines are applicable to the small and mid-sized banks, and as such acts as a complement to those guidelines. Moreover, we have introduced a number of Canadian innovations within the Pillar 1 capital and liquidity requirements to help reduce the complexity of the frameworks for smaller institutions. The three principles governing OSFI's approach to domestic implementation of Basel III are critical for Canada. At the same time, we also recognize that intent and execution may not always align as closely as we might wish. This is why we began extensive public consultations on our Basel III and SMSB proposals, as well as our revised Pillar 3 disclosure requirements for systemically important banks last month. The window will be open until June the 4th of this year, with consultation changes to Pillar 3 open until July the 2nd. We will publish a summary of comments with the release of our final guidance in late 2021. I'd like to stress that we believe that now is the right time to move forward with these changes. We believe that full and consistent implementation of Basel III is an essential part of preserving resilience in the global financial system and is integral to OSFI regulation in Canada. As well, timely implementation also gets us ahead of the new risks, allows us to say it's done, and thereby helps us focus forward on the new normal and on being prepared for the unexpected. In short, we've spent enough time on post-GFC regulatory reforms. Let's get them in place and focus on lessons from the pandemic and beyond. While we remain focused on concluding the round of Basel III reforms and managing pre-pandemic financial risks and vulnerabilities, the impact of COVID-19, coupled with broader developments in the risk environment, also pose new challenges to the future design of bank regulation. As well, OSFI's vision is a reminder of the importance of continuous improvement in prudential regulation, preserving confidence, ever vigilant, always improving. What then lies ahead in the evolution of prudential risk oversight? I see two key things to think about carefully. One, the importance of flexibility in the new normal. And two, our focus on new and evolving risks. Let's start with flexibility. The Basel III framework is just that, a framework. It sets out a minimum international standard whereby national regulators can build their domestic rules for capital, leverage, and liquidity requirements, while also recognizing that national implementation may differ in some limited instances. Flexibility is a desirable, indeed a necessary component of that framework, particularly in dealing with an increasingly volatile, uncertain world. Now, more than ever, we need rules that can adapt effectively to changing conditions, while at the same time not undermining the credibility of prudential regulation. We have seen the need for, and benefits of, more dynamic regulatory design frameworks, especially throughout the last year. This is part of the reason we developed overarching principles for regulatory changes during the pandemic to ensure that changes could occur that were credible, consistent, necessary, and fit for purpose. At the onset of COVID-19, we took a decisive and precautionary step to reinforce the financial resilience of banks and insurance companies by introducing a number of temporary restrictions on capital distributions. These included prohibitions on share buybacks and increases to regular dividends and executive compensation. Now, slightly more than a year following the introduction of these measures, we continue to monitor the overall conditions triggered by the pandemic to determine when it will be appropriate to unwind these restrictions. OSFI is acting prudently in the context of continued uncertainty related to COVID-19 and will maintain the restrictions until they are no longer fit for purpose and once we have greater clarity on the path forward out of the pandemic. Our review of our expectations related to capital distributions remains ongoing, and any decisions related to the unwinding of these restrictions will be communicated quickly and transparently and well in advance. When it comes to the Basel III reforms and OSFI's approach, there is also flexibility in how requirements for capital and liquidity buffers operate, depending on conditions and capital levels. Such flexibility was particularly important given what we have all experienced over the last 14 months. Our approach was a nod to the fact that we did need more flexibility in the application of rules than perhaps we envisioned before 2020. And I suspect that this more flexible approach to regulatory and policy design will need to follow us into the future if we are to respond effectively to the demands of the risk environment. That takes me to our second focus, responding to new and evolving risks. While the Basel III reforms promote resilience, they cannot be addressed in isolation from other factors impacting institutional and systemic resilience. Pre-pandemic financial risks haven't somehow quietly retreated off the global stage under the COVID-19 banner. Indeed, some existing risks have been increasingly prominent and have become prominent, while some newer risks are revealing themselves. Technology risks and risks stemming from environmental, social, and governance impacts could manifest into financial risks if left unchecked. Similarly, the features and risk characteristics of new asset classes, such as crypto assets, need assessment to determine the design of an appropriate prudential treatment for banks' exposures to them. By extension, OSFI may incorporate these risks into regulation and/or supervision, depending on the prudential risks and our understanding of them, as well as our own evolving approach to risk management expectations for financial institutions. Therefore, in keeping with our mandate, we are promoting broader engagement with stakeholders on these evolving families of risks, with wider and more open public consultations on technology risk and climate change informing our path forward in dealing prudently with these risks. On the global stage, the Basel Committee is also focused on these non-financial risks. At the end of last month, it released principles for operational resilience and operational risk management, which aim to make banks better able to withstand, adapt to, and recover from severe adverse events. It also recently issued analytical reports on climate-related risks that examines the transition channels of these risks to the banking system and reviews the measurement methodologies of climate-related financial risks. Going forward, the Basel Committee's 2021-2022 work program outlines key priorities along a number of critical fronts. These include COVID-19 resilience and recovery, horizontal scanning and mitigation of risks, strengthening supervisory coordination and practices, and evaluating Basel III implementation. OSFI supports these priorities, knowing they will serve us well as we respond to an increasingly diverse and uncertain risk environment. Complacency is our greatest risk to financial resilience, and we must therefore remain vigilant. In concluding, I want to reiterate that timely implementation of the Basel III reforms is central to OSFI's prudential priorities. The innovations related to capital, leverage, and liquidity regulation are essential to preserving financial resilience. At the same time, sound regulation needs to continue to be backed by strong supervision and appropriate public disclosures. As a consequence, there is quite simply no time to waste in completing Canada's implementation of this last phase of the Basel III reforms. The GFC has lessons for us to memorialize, and the risk environment poses risks that are not going to wait for us. We welcome your feedback on Basel III, and we look forward to a broader discussion of the future of bank prudential regulation to address the various and accelerating forms of innovation in the financial industry. Thank you again for joining me today, and I look forward to the questions you may have.
Thank you, Ben. It's been a long journey, Basel III, I must say. So any questions, please put them into the chat, addressing it to all panelists. But I might just kick it off with, so Ben, do you foresee any of the proposed guidelines where Canada will be different from the international standards? And if so, what makes Canada's situation different from those markets?
So, as I mentioned in my remarks, the Basel III standards are minima. They're the baseline upon which we build. So we certainly are using that as the building block, and our expectation is that we are substantially compliant with the key features of the Basel III framework. Where we differ, if you will, where are our local innovations? Well, they can be super equivalent to those minima. So, for example, the output floor that sort of governs the extent to which capital can fall away from modeled approaches. We've chosen to accelerate the implementation of that output floor. We're starting at 65%, not 50%. and we're implementing it over 3 years. That would be an example where we would be super equivalent, again, on side. The point around the small and mid-sized banks, I think, is different and important. The Basel III framework was not intended for non-internationally active banks. So we've taken, we believe, the best innovations there, and obviously the need to focus on capital, leverage and liquidity. But we've looked at the measures of risk we have and asked ourselves whether they are doing an effective job of really reflecting the risks, the unique activities, and also allowing supervisors and firms to use them in a meaningful way, which in large part means making them clearer and simpler. So we think all those steps preserve resilience. And again, for internationally active banks and for the system as a whole, very much in the spirit of the Basel III reforms.
Okay, I want to dig in a little bit more on that proportionality, and that's a very key feature of what you've proposed here. Why is that proportionality so important for Canada?
Well, first, as I alluded to in the speech, the notion of having specific rule sets for smaller and less complex institutions is not new. There are many other jurisdictions, the US obviously being the example. So, I think there are lessons to be drawn about thinking very carefully around local banks, the risks they run, making sure that the measures of risk we have are appropriate. At the same time, the Basel framework itself has introduced the notion of proportionality by having different, standardized model approaches as well. So the underlying principle of proportionality, we're just extending that, and also recognizing that some parameters may or may not be relevant. So, if you're a small firm in trust and custody, credit risk requirements may be less important than operational risk requirements. And so looking at that as an example, I think is going to be important. Understanding these activities, understanding there are niche players, and making sure that we have a framework that reflects those risks appropriately and clearly.
Is there any, comparative views that, to make the smaller players more competitive by using these proportionality frameworks, or is that not part of the mindset of why it's being implemented?
Our overarching focus here is to preserve confidence and resilience in the financial system. But we also recognize that our mandate is that firms need to be able to compete and take reasonable risks. That means they're just understanding the risks and ensuring that they're suitably compensated for. We think taking out the complexity takes out the risk of confusion as well. And I think from our perspective, it reinforces resilience, it provides clarity, it reflects the risk more appropriately, and therefore is more fit for purpose.
Okay, so we're getting a few questions out in relation to some of the non-financial risks, and in your speech you've alluded to a couple of them, growing in prominence. And so I'm going to start with one that certainly has in the COVID environment, and given the way that we're even communicating now. So cyber risk. How is OSFI looking at managing, or how banks are managing these complex risks? What can we expect to see when it comes to regulation guidelines for Canadian financial institutions with cyber?
Thank you. So I think it was September last year, we issued a discussion paper on risks flowing from technology. It was quite a waterfront piece. We were looking at many different aspects of technology and how it impacts the risks of our institutions. That consultation concluded, and we're shortly to release a summary of those consultation findings. But I would sort of summarize to the question of, well, what can we expect from OSFI? I would summarize a few things in this regard. First, I think there is a sense that OSFI's approach to regulation, being principle-based, is one that we should continue with. Second, the area of technology risk is one that benefits from a myriad of different frameworks to manage the potential risks that an institution faces. So OSFI coming out with yet another framework, I don't think has been viewed as necessarily value add. So obviously whatever we produce, I think needs to be able to build on top and leverage all the other great innovation that has occurred. We certainly have heard and believe the need for a sort of chapeau technology risk guideline and overarching piece, high-level framework to sort of govern our thinking on these developments. But I think we are very mindful to stay away from a wide range of prescriptive rules. There are some areas where we may be leaning in and providing specific elaborations. Third-party risk is clearly one. The use of AI and machine learning is another. We also have specific expectations on the reporting of technology incidents, and that's a very important part as we manage this. It's becoming part of the day-to-day management that we're clear on incidents, how they're managed, how they're reported, so that they can be triaged and responded as effectively as possible. So I would say that you can expect quite a lot from OSFI over the next year or so. Last September, I published for the first time a set of prudential policy priorities because I wanted the public to understand what were our focus through to June this year. We will be making that an annual occurrence, and I'm hopeful that we will be able to publish very soon, next month, our priorities for the coming year, in addition to the feedback on tech risk. So you'll be able to see how the feedback lines up with our production schedule, and hopefully that will give people a good sense of clarity. But we know this is an area we have more to do in, and we're working expeditiously to provide that clarity.
Okay, so adding on from our discussion of cyber and tech risk, we're getting a few questions around operational resilience. I guess, what's your take on that, and how do you see OSFI navigating the operational resilience pathway?
So one of the big questions for any piece of regulation is to be clear on what the effective outcome you're looking for. So, I mean, we can come out with any number of pieces of guidance on technology risk, but you're still ultimately looking for the so what. And I think the so what in this space is operational resilience. That's the litmus test, that depending on disruptions, depending on threats and vulnerabilities within the non-financial risk space, can firms continue to offer critical services and weather the storm? So from our perspective, the operational resiliency objective, and the Basel Committee recently came out with its own principles on this, is a key yardstick to sort of gauge and assess success, and will also be part of our plan to sort of link it into our regulatory framework. So it's central. It will be linked explicitly into our regulatory regime. We very much support the Basel Committee's principles, and we're very active in developing it. And we certainly think if, for firms, financial resiliency is table stakes, and we've talked a lot about that today, but the cousin here, the sibling here is operational resilience. And I think as an objective for risk management, I would encourage all banks to continue looking at that and building out their own capabilities in that regard.
So continuing on from the non-financial risk themes in anti-money laundering risk and OSFI's approach in mitigating this risk, particularly with Canadian banks with operations in riskier jurisdictions, and the fact that the global economy or global political risk situation is probably more volatile now than it was 5-10 years ago.
Yes. So again, another area of operational risk that needs to be considered is obviously compliance with a whole range of legislation, and compliance with anti-money laundering legislation is obviously key. We have had a tradition of obviously looking at that as with a range of different statutes. With the maturity and growth of FINTRAC, which is the primary agency responsible for enforcing the Proceeds of Crime, Anti-Money Laundering, Terrorist Financing Act, we continue to work closely with FINTRAC on supporting them in their assessments and enforcement. We view this as obviously key to reputation and preserving reputation and trust and confidence, and obviously believe that the banks we supervise need to continue to pay close attention to that legislation, as with all other forms of legislation, in ensuring we have a system that continues to be resilient and that stakeholders can continue to be confident in.
Now, pivoting onto climate risk, so once again, continue the non-financial risk theme, but we're getting quite a number of questions here regarding climate risk. OSFI's taken some, very unique, very interesting approaches, such as your scenarios pilot that you've got out there. Tell us more about that. Tell us why that's been done and what you are doing.
Okay, I may take a little longer in answering this question.
Yeah, no, go for it. This is very interesting. I'm sure all our guests would love to know how this came about.
And by all means, cut me off if I'm going on too long. So a bit of background here. So internationally, there's clearly been a lot of attention paid here with a view very much focused on public disclosure and obviously what goes into those public disclosures in supporting and responding to the risks posed by climate change. Clearly, those developments at FSB and beyond, I think, have been very helpful. We continue to encourage adoption of those recommendations within our own institutions. At the same time, we felt it was important to provide a prudential point of view on climate change. And we prepared a discussion paper that was issued at the beginning of this year. And that concluded, I think, consultation April 2nd. It was intentionally discursive in nature. We were open-ended. But what we wanted to do was lay out clearly what we felt were the key channels for risk to the regulated institutions we oversee. So, we have the physical transition liability, how they may manifest in market, credit, insurance, and liquidity risk in concept, as well as in practice, and to seek views around risk management and potential practices in promoting greater risk governance of these risks as they evolve. One of the things that we have been clear on are sort of the right conditions to be able to build what I would call sound regulation and effective supervision. And that all starts with good evidence, good data, good evidence upon which to inform decisions and approaches. And of course, in this area, we have limited historical experience by definition. And we also have a set of risk methodologies that have been good in quantifying traditional credit risks and market risks. But now we're asking those methodologies to actually consider timeframes and time horizons that aren't 1 or 2 years, 30, 40 years longer, and also envision different kinds of data and risk drivers that we haven't captured necessarily to date. So what we thought would be helpful, and again with the leadership of the bank, would be to pilot our own exercise in exploring methodologies and practices to get a handle on some of these risks, particularly the middle category, transition risk, which arguably is, very long-term or potentially all-encompassing and quite varied, but again, lacking from consistent methodology, lacking from necessarily lessons learned, although again, the Basel Committee's report of last week is a helpful backdrop to that. So the pilot with the bank is our own experiment. It's an experiment that we think is worthy and relevant given the risks that we're obviously confronting. And it's one that we want to be able to share the lessons with industry and broader stakeholders. So we've got this pilot, it's going over the year, it's in 2 phases, and it will implement climate change scenarios to test and quantify provisionally transition risks. The first phase is really work to date has focused on developing a set of Canada-specific climate change scenarios that can be used and be modeled by participants. And we're looking to complete this in the first half of 21. And in there will be things like scope, sectors, which sectors, defining emission intensity, intensitiveness, geographies, the risk types, and the way in which we're sort of defining the assessment and impact. Next, using those scenarios, we with the pilot participants, and there are a number of institutions with us, We'll explore the potential transition risk exposures to their balance sheets using the inputs and structures that we've provided. And included in that, we'll be looking at, relevant governance and risk management takeaways. And we're looking to complete that second phase within the pilot institutions in the latter half of 21. The bank and OSFI is going to publish a public report planned for the end of 21, sharing details on the specific scenarios, methodology, assumptions, and key sensitivities. The climate scenarios, methodologies, and lessons learned from the exercise will be shared with the rest of the financial institutions, allowing them the opportunity to test the scenarios and build up their own capabilities. And I think is going to be an excellent starting point for a discussion of the strategic and business model risks that confront our institutions from disorderly climate transition and change. And, we view this as an opportunity to promote risk management practices and dig deep on getting the right evidence, the right tools. And from that, I think you'll have the necessary conditions to build regulatory and supervisory expectations quite quickly. But it is complicated. The devil is in the detail. And we have to work very hard to sort of build out these capabilities, which is why all the great work happening internationally is going to be very helpful in building out these capabilities.
Yeah, that's excellent. Is it fair to say, Ben, that this is a Canadian innovation, and we're the only jurisdiction that's really taken this by the throat and going for it?
I think there's been a number of innovations around the globe, particularly when it comes to sort of running climate stress tests. I think this is a little different in that we're really digging deep on the methodology side and sort of running an experiment with participants and sort of test and learn, let's call it, approach. And obviously our partnership with the central bank, I think, is a great development. I mean, we obviously work closely with the bank, but here, bringing the economists, bringing the sort of financial risk quantification experts, bringing in the financial institutions. I think this is a great way to sort of triage and think about the problem. And if that creates a bit of innovation along the way for Canada, then so much the better.
Oh yeah, no, it's certainly a great initiative, and I think everyone in the audience, we really should be paying very close attention to this pilot. Certainly looking forward to the results later in the year. Continuing on from that, it's in that they've got a couple of questions in relation to reputation risk. So I'm interested in your views on reputation risk, one from the longer term perspectives with climate, but secondly, just even reflecting on maybe your time in APRA, where reputation risk was key to that jurisdiction.
Yeah, so again, you talk about how do you know things are effective? Well, the key outcome of everything here is about preserving trust and confidence in the financial system. And reputation is what it's all about. So clearly, why are we interested in cyber? Why are we interested in many of these non-financial risks? It's because, or third parties, or AI and machine learning, it's because if left unchecked, they have the potential to disrupt reputation and in turn potentially pose a material financial risk to the institutions we see. So reputation is sort of the lens that we look through on much of our work. And of course, we focus on prudential risks. So these are material, financial, safety and soundness issues, we don't deal sort of line by line compliance with legislation. That's either the responsibility of other agencies or indeed ultimately it's the responsibility of the firms. We clearly will go where the overall risk demands. But, clearly, lessons, I won't pick on any particular institution, I think it's uniform. There are always lessons on compliance risk and breakdown on compliance risk, basic breakdowns on good risk management that obviously we need to pay close attention to, because that undermines confidence in risk management, it undermines confidence in the financial institutions. So it's table stakes for us, and I think there's always lessons to be learned when these things don't always go to plan. There's lessons learned overseas. There's always lessons we can learn domestically. And I think my only message on compliance and conduct is, they are a channel to disrupt reputation. And so remaining focused on those obligations and on the basics is table stakes and is critical.
So I'm not going to let you off the hook on your APRA experience that easily. So I am going to ask. So if you had to compare your time with APRA and OSFI, compare and contrast. What things did you bring back?
So I have many wonderful memories of my time in APRA, and I was very privileged to be able to work with Wayne and his leadership team. It's a phenomenal organization. I learned a lot. And I think, OSFI, if there are benchmarks for OSFI and APRA, they are, we're pretty good benchmarks for each other, both in terms of size of our organizations, but also in some ways the structure of the financial system we oversee. But there are important differences. APRA is a resolution authority, so think of OSFI combined with CDIC. APRA also has the whole pensions industry. We only have a small but important part, but it's still a much smaller part. So the scope of APRA, I think, is a little different. And so, there was clearly lessons and insights for me in that regard. And absolutely, the implications that, the Australian financial system has been through, the reviews, the independent reviews that they have been through, certainly led to a robust public dialogue. But I think APRA was stronger for it, and I think APRA had a great place in promoting great outcomes for the financial system down there, and I was very lucky to work with them, and we continue to work closely on common areas of interest.
Okay, so I'm going to switch back over to Canadian firms. We spent we just talked about cyber, reputational, climate, operational resilience, technology. If you were one of the smaller sized or mid-sized institutions who was just really strained for resources and expertise, what advice would you give in prioritizing or triaging the types of activities in regards to such a wide spectrum of non-financial risks?
Well, so one of the things that we are recognizing in our sort of forward plan for guidance is the need to share information or good practices perhaps in a more frequent and regular basis than we've done traditionally. And there are certain types of information, and we do cross-system reviews, we're able to share comparative results back to institutions, but I think there's opportunities there to do a little more in that regard. I think there are also, opportunities for us through the discussion papers and the dialogues that we have with institutions to bring in and share expertise and lessons learned in a more coordinated and integrated fashion. I think the one challenge here is non-financial risks don't care whether you're big or small. They don't discriminate. And so, when we think of our expectations for risk management, around third-party risk management or disruptions from cyber threats, there are certain areas of expectation that we're going to have to think very carefully about. There are thresholds, if you will, for expectations that are hard to flex, that's hard to be proportional about. And so our consultations will be very much focused on that, understanding how we set our expectations, the implications that has for the smaller institutions, while recognizing that there are risks that do need to be prepared for and responded to. So I think you can expect a lot more consultation, more information sharing. I think there's broader common interest in managing non-financial risks, and I think that will allow to some extent a greater dialogue with the firms, recognizing there are obviously also very important security issues to bear in mind as well.
Okay, so we might spend the last few minutes back onto the more financial risk side of things, or the more quantitative side of things. So you mentioned in your presentation, there are signposts that OSFI is monitoring in relation to COVID-19 situation. Are you able to elaborate on what sort of metrics you're looking at in that regards?
Yeah, so I mean, the two pieces that Jeremy spoke to when he made his speech earlier in the year, I mean, there's clearly the broader economic outlook. And there, we've got obviously a range of forecasts, not least the view of the central bank and other stakeholders in looking forward. And there, compared to a year ago, we have far more certainty. I think we have far more confidence in the path ahead than we had a year ago. And we've also had the benefit of a year of experience in the financial institutions managing through uncertainty. So in both cases, I think we've gained very important insights and experience that is instructive to us. At the same time, I would say we've also got to bear in mind what's happening on the health front. And another gate that we were obviously considering is, we've got to be seeing a way to out of the lockdowns. So, currently, obviously, that's not the case. So, continuing to keep an eye on how restrictions are going, how the variants are happening, the vaccine rollout and so forth. The health outlook, I think, is also a relevant input as well. But both, I think, input the broader prudential point of view, which ultimately informs the decisions we take.
So another question from the audience is in regards to stress testing and whether you potentially that we'll see a more prescriptive stress testing regime similar to CCAR or DFAST that you see down in the US.
So we have our own rigorous form of stress testing that we perform with our institutions. The difference clearly being we don't publish the results the way they do in the US. And we think that has worked and served us very well. I think we continue to look at our stress testing methodology, and certainly when I was around for the first incarnation way back in the system stress test in 2009, it's the evolution has been amazing to see, and the depth and rigor and the analysis that we're able to perform is, I think, very impressive. But clearly, we continue to sort of build up those practices over time. And as I said, we've now got to think about incorporating these non-financial risks into a broader sense of stress testing, which may be financial, maybe non-financial, maybe a mingling of both. And that's certainly where I think our pilot work with the bank will also add to the tools that we use.
Okay. And the final question in more the financial element is, in your potential enhancements in the assurance requirements. They're quite wide-ranging. What are the current shortfalls in the assurance framework that you felt would necessitate these changes?
So we view this paper as a proactive step. It's not really a response as much as an opportunity to be continuously improving. I think it's also not just banking here. So, Basel III on the banking side and IFRS 17 on the insurance side, these are very significant sort of regime changes, if you will, to the way prudential measures of risk are being calculated for capital. And so we thought the timing was appropriate, building off those regime shifts to do an opportunity to check in and confirm and update those assurance expectations. So I think they're very complementary. We do look to external assurance to inform the work that we do as supervisors, and the opportunity to kind of line that up with the Basel III consultations, the work that's going on for IFRS 17 and the capital on the insurance side. We thought that all lined up very well, and was an opportune moment to get your feedback and views as to whether those expectations, how and where they evolve.
Okay, so we're almost at the top of the hour, but I want to have one final question I want to squeeze in just for completeness for the guys, and before I leave you with any final comments. So the final question, regulatory framework and whether there will be changes to cover the fintech challenges and new fintechs that are entering into the market.
Yeah, so I mean, there are, I think, some legislative changes that will, I think, have some implications. But you know, our view on this is innovation is nothing new to financial industry. It continues to take place, and I think we certainly view those developments as necessary and as sort of a reflection of a healthy operating financial system, and continue to look at our rules and regulations to ensure that firms can continue to compete and take reasonable risks. We've had a little bit of feedback on our technology risk paper in that regard. But I'd also note that, you know, we clearly, when it comes to banks and institutions involved in banking activities, you know, you have the pleasure of OSFI as a federal regulator, but there are a range of financial institutions that don't call themselves banks, that are not necessarily part of our oversight, that also have the opportunity to build out innovation and develop as well. So I think there's a range of areas where innovation and fintech can develop, and we're certainly looking at our role and making sure our regulations remain fit for purpose and continue to support safe innovations.
Okay. So any final thoughts you'd like to leave us with, future priorities maybe?
Well, so just a look out for our priority release next month. I think it's very much anchored on financial and non-financial work. We've got a lot to get out and an ambitious agenda, and obviously looking forward to your feedback on that, and making sure that you give your fearless feedback and advice on the Basel III proposals. We think we've put together a comprehensive sound package, but obviously looking forward to your feedback and obviously going through the impact studies to ensure we get the final calibration and approach right for Canada.
Okay, thank you, Ben, for joining us today. We here at GRI certainly share OSFI's commitment to financial resilience and vigilance on risk management. Thank you for sharing your insights on the future of banking capital regulation, and look forward to the ongoing discussion on supporting the safety and stability and innovation in the financial industry. So to all the attendees, thank you for your participation today and your engagement for this discussion. Thank you all for joining.
Thank you, Bruce. Keep well. Bye-bye.